Quick disclaimer, these discussions are intended for education and informative purposes. They are not to be used as legal advice. Welcome to the 256. I'm JD, host of the 256 Investor Podcast. This is for both the seasoned investor building a portfolio of rental properties that wants to sharpen their skills and for the potential investor that needs to answer some questions and gain strategies to invest with confidence. We'll discuss all things investing, legal, tax planning, acquisitions, insurance, and of course, we'll discuss real-life experiences with 256 investors. Whether you live in the 256 or invest from afar, this is for you. Thanks for joining us once again, the 256 Investor. We have a really special guest who came all the way from Nashville, Tennessee to see us today. This is Luke Hayes, Hays.
That's right.
Right.
Yeah, no
okay.
E. Put an E on there, you're gonna get the wrong person probably.
Luke Hayes with IPX 1031 Exchange. Tell us about yourself and your company.
Yeah, I appreciate you having me. So I'm an attorney with IPX, and this is all we do day in, day out are 1031 exchanges, which we're going to kind of dive into, discuss why people do them, discuss some of the rules, some of the potential curveballs you might see when you're doing an exchange, kind of the benefits. So you'll get the whole kind of full spectrum, on this podcast. But yeah, I started in 2018, kind of fresh out of law school. So I grew up in Birmingham, went to Alabama undergrad. Before we began, you had an Auburn Cup, so I almost left the room. But
it's not the first time that's
happened.
Yeah,
we put that behind us, and then went to law school at Tulane. I always make a bad joke about New Orleans, great place to visit, probably not the best place to study law, right?
Yeah,
but
exactly.
Graduated on time, and then didn't really know what I was going to do. Did some legal recruiting, and then I kind of happened into this. So I've been doing this for now 7 years and probably done about 5,000 or 6,000 exchanges at this point. So what do you have to get to 10,000, I think, to be an expert?
There you go.
But that's 10,000 hours. That's right.
Yeah,
my
we'll
hours
assume
is
an hour
probably
per.
well above that. So.
It has to be. And 1031 IPX has offices in Alabama, Tennessee, Florida. Do I have this right?
Well, this is kind of our nuance. So IPX is wholly owned by Fidelity, National Financial, F&F. A lot of people confuse that with Fidelity Investments. It is a different company. F&F is known for being the largest title insurance provider for real estate, I believe, in the world. But so we're owned by F&F, and it's really F&F offices that, they'll save a room for me if I'm in the area. Okay. So we got offices, in Birmingham, Franklin, right outside of Nashville, Pensacola, I think, as well, and Jackson, Mississippi, though, to be honest, I've never been to the Jackson office. But a lot of my job is, most everything I do is on the phone. 1031 isn't like something you're showing to anyone. It's not like a car. It's really conceptual idea, right? Part of the tax code. So a lot of people like to meet, but I probably do about 20 to 25 calls a day. So it would be very difficult, actually probably impressive if I were able to meet, a lot of people in person. But usually my presence is to teach, which I believe is kind of how we first met. I teach a lot. I'll teach to realtors, CPAs, attorneys, kind of just over the basics and when to spot it. My biggest competition, I would say, isn't per se other attorneys or other companies that do this. I think we do it better, right? We have better protections, which we could cover, but it's really lack of knowledge. People don't know when to bring it up. People don't know the rules. And we could maybe go down this route. I had a gentleman email me a question yesterday. He included a screenshot from AI, Google AI. He was like, well, this is the response I got. The response was just completely off. And I don't necessarily blame AI. It was kind of how he phrased the question to AI, but it got tricked. And now we're starting to get into that where I used to have people just say, I don't know anything, which was not too bad, right? Versus I think I know X, Y, and Z. I think that might be worse because if 70% right, that 30% is really going to get you, and you think right, potentially more than you do. So, but that's kind of the nature of the beast, and that was a long-winded answer for 7 years.
It's good to say that you specialize in what you do.
Right.
What do you have to do? So you're a qualified intermediary. We'll get to what that means in a minute. But what do you have to do? Do you have to have a special license, pass a special test to be a QI?
Yeah, great question. So in order to be a qualified intermediary, the direct definition from the IRS is you must not be disqualified, which is, I think, funny, right? But to be disqualified means you've been an agent of the exchanger within the past 2 years. So, an agent of a taxpayer looking to do a 1031 would be any direct family members. They don't want your parents, grandparents. They don't want the closing company to do it. Right? You couldn't
Right.
assist on your client's own 1031s, CPAs, attorneys. So no, you don't have to be a licensed attorney. Like a lot of people ask, well, am I only allowed to do 1031s in Tennessee? In fact, as an attorney for IPX, we're not giving specific tax or legal. My job is to spot the issues, and then basically, if someone wants to move ahead, we hold the money associated with the exchange and the sale. But we're never acting as an agent of the taxpayer. So with that in mind, no, you don't need too much in terms of prerequisites, which can be pretty dangerous, I would say, actually. There's unfortunately been cases of fraud, QIs, qualified intermediaries, stealing funds. There was a pretty famous case of an attorney in Miami a few years back stealing 7 or 8 million worth
Florida man.
Yeah, exactly. There are a lot of smaller, I would say, operations, or maybe just people that think it's a easy way to make a quick buck that get a decent amount of the rules wrong. So you really need to be careful on who you use. We in my classes, probably at the end, you probably remember I kind of go over what separates us, from competitors, and it's how we protect clients' funds. It's the safety protocols we have in place, and it's really our expertise. The fact this is all we do. Now I am an attorney, and I'm a certified exchange specialist, so that was a test I took. There's, I would say, a good number in our industry, are that CES certified. So that was, people said it was a challenging test, but I guess if you study for 5 years, which is basically, because this is what we do day in, day out, it wasn't too bad. So I'm pretty active with the Federal Exchange Accommodation Association lobbyist group. That's kind of a different nuanced approach to keep the 1031 intact. We go to Capitol Hill and speak to our local, representatives. I sometimes make a joke, your congressman, your senator, they're a little bit usually less sophisticated than some of the clients we have, but we'll steer away from any political talk for sure.
You're with the Tennessee bar, right?
Mm-hmm, that's right.
I get a lot of people who they're going through the 1031 exchange process, and they'll tell me, I found a cheaper QI. I found somebody who will do it for less than what a reputable company that has the core business of 1031 exchanges. And I always tell them, that's like someone who puts their rental properties with a real estate agent who's never done any form of property management before, but you don't have to have a special license to do it. Right. If you have a salesperson's license in the state of Alabama, you can do property management all you want. That doesn't mean they should do it. Right. And if they cut their rate, there's even more cause for concern to me. So I'm glad that you guys, this is your core business.
I get that. And you don't want to be outrageously expensive. I'm not going to use the cliche, you get what you pay for, because I think I'm always try to be, kind of understanding or aware of the fee versus what people are trying to defer. Sometimes I think I'm a little sucker to myself in terms of the reduced fees I do or some of the discounts. Maybe don't quote my clients on that. We'll see what they say. But yeah, I think we're pretty competitive. A 1031 with us would cost between $1,000 to $1,500 on average. I think, usually that's on par, if not sometimes cheaper than some of the, a local attorney. I've had people say that they were quoted from other people like $4,000 or $5,000. It certainly shouldn't be a percentage. It shouldn't be a percentage of the sale. There's not too much difference between a $100,000 sale and $100 million. Right. Maybe besides egos, right, in those cases. But the work from an exchange perspective is relatively the same. But yeah, there's like a couple companies out there that maybe charge in the 500 range. Usually they do some hidden fee, tactic, right? They nickel and dime you sometimes on the back end, or you just really don't have great, customer service in general. My most valuable asset is availability, right? My best ability is availability.
There you go.
There's a sports analogy for you, but I try and always be available to our clients. With IPX, you're going to have two people on a file. You're going to have myself as kind of like an advisor, and then you're going to have your own coordinator, kind of like a paralegal, I would say. So we kind of work hand in hand. But the fact we're nationwide means if I'm out sick or take my rare vacation, there's going to be someone available. So, 1031, if we want to kind of dive into it, it's all about timing, right? It's all about multitasking to a degree, how I frame it. Because people ask, well, why can't I do it on my own, right? So the first thing you need to know about 1031s is you can't do it on your own. You have to use somebody, and you have to have it set up prior to the sale closing. So, I begin most of my classes, almost every class with a kind of a hypothetical of a call I get where someone rings me up, I answer Luke Hayes, IPX, the person on the other line. Sometimes they're in a panic, sometimes they're very calm, but usually they'll kind of be like, well, I heard about this 1031. I have a sale. It closed, last week. Sometimes they say I have the money in the account, or sometimes they say no, it's still with the closing company. They ask, what do they do? And I tell them there's not much to do at that point, right? The 1031 must be set up prior to close of sale.
Right. They either got bad advice or they got no advice whatsoever.
Usually it's none, no advice, or yes, occasionally bad advice. I've had a lot of people say, well, what are, I was told X, Y, and Z, can I use that as a reasoning? No, the IRS doesn't take much sympathy on bad advice. So the onus is still on the taxpayer. But, I had a really bad scenario. It was like earlier this month. And, it's really unfortunate when someone has an exchange that would have fit all the boxes. So this person, his sale was like a month past. So it was a long time ago. But he did have a purchase picked out. It would have satisfied the rules. It would have been a fairly easy 1031. He had it picked out before he closed on the sale. So every now and then we'll get people that call us, and you can kind of read between the lines and see that, they probably just didn't think they'd find something, and then something popped up and they kind of, changed their minds. A lot of people do take, I would call like maybe a flyer or Hail Mary attempt with a 1031, because usually, our fee of $1,000 or $1,200, which you do incur regardless of your success, that's a lot better than not taking the chance in many cases, and then, receiving the money and then finding a property after. That's, I always tell people, look, if you're gonna, which scenario is gonna make you feel worse on, you taking a shot at a 1031, nothing comes available, and then you getting your money back after, a month and a half, or you not doing an exchange, a property comes available that you just didn't think would become available. Well, it doesn't matter, right? So, for this particular person, he actually did a previous 1031 a while back. It was his wife though that told him he could do it after. So he was on an unfortunate situation. You can't really complain too much when it's your wife. I felt bad, but it was a learning experience. I think this gentleman has other properties. That's how I try and frame it. Hey, let's not make sure it doesn't happen again, right? So, hopefully this podcast catches a couple of viewers that have that situation come up, and then you can catch it on the front end.
Yeah, like I said, if you need to work with somebody who does this as their core business, and if an investor is working with a real estate agent, they need to work with a real estate agent who's been down this road too, and can properly advise them. Because a lot of people will tell their clients, I'm sure you can exchange this on the back end. After you've sold the property, they just assume. You can't assume anything when we're dealing with IRS tax code.
That's right.
It's very strict. I'm going to read this straight from your booklet, IPX 1031, and then it'll set us up from where we can go from there. The tax-deferred exchange, as defined by the 1031, Code of the Internal Revenue Code offers taxpayers one of the last great opportunities to build wealth and save taxes. By completing an exchange, the taxpayer exchanger can dispose of investment or business use assets, acquire replacement property, and defer the tax that would ordinarily be due upon the sale. To fully defer the capital gain or recapture tax, the exchanger must A, acquire like-kind replacement property that will be held for investment or used productively in a trade or business, B, purchase replacement property of equal or greater value, C, reinvest all the equity into the replacement property, and D, obtain the same or greater debt on the replacement property. Debt may be replaced with additional cash, but cash equity cannot be replaced with additional debt. Additionally, the exchanger may not receive cash or other benefits from the sale proceeds during the exchange. Okay, there's a lot there, but that will set us up for everything we need to discuss.
It's like someone, spoke a different language, right? Now, to me, that was music to my ears, right? All the good stuff, all in one. So I like to kind of break it down. What is the best comparison to a 1031? The best comparison that most people are familiar with is a 401k, right? Mm-hmm. A 401k, pre-tax dollars, you get from your job, your company matches it. You hopefully, right, to a certain degree, you put it in the stock market. Why do people utilize that? Because pre-tax dollars grow at a faster rate, so that when you're retired and you cash out, because at that point you do incur the tax, but it's of a much larger value, right, than if you didn't have that opportunity. Well, the 1031 is exactly that, but for real estate. But it's a lot better because it's uncapped, right? 401, you can only put it in a certain amount. They raise it incrementally every year, but 1031, there is no cap. And that's, again, one of the things we do in DC is to make sure there isn't a cap, and we explain how a cap would basically be the same as a repeal. A lot of our clients, I would say a great example are farmers. Farmers don't have much in terms of traditional retirement accounts. Their retirement is their farm, right? And so there are some in-game strategies for people that, they can put their money from the sale of their farm if they're, wanting to kind of cash out, so to speak, and put it into like passive investments or to properties that have property management companies, so that's a great example where if there was a cap, you're really punishing farmers for just being in their individual industry, right? So, but the 1031 is very comparable to a 401. It is a deferral, right? We always try and make that clear. Everyone comes and says, well, I do one exchange, I cash out.
It's not an elimination of taxes. It's a
that's
deferment
right.
of taxes.
If it were an elimination, you wouldn't have been able to book me because I'd be so busy, right? I mean, literally everyone would be doing 1031s, and we'll go over.
This is tax avoidance, not tax evasion.
I wouldn't necessarily say, well, yeah, tax avoidance. I mean, so what is a deferral? Here's a very simple kind of breakdown, and this will be a good kind of case study of why someone would do a 1031. So I'm pretty good at math. I'll try and do like a simplified version. Let's say we have a person buys a property in Alabama, right, for let's say $250,000. Okay. So pretty traditional, like for an investor, first time buy. So that's what we call their initial cost basis, Now, I'm going to point out a nuance here. Does it necessarily matter whether I bought that 250 property all cash or if I bought that 250 property 20% down? The answer is no, right? What I paid for it's 250. The fact that I owe the bank 200,000 if I were to sell it, that's very important. That's an important factor, and I got bills to pay, right? I got a monthly mortgage to take care of, but it doesn't change what the IRS considers is my initial basis. They're both 250 in either scenario. And I say that because in about 5 minutes, I'm going to address the requirements, which you already mentioned, to fully defer. And I'll go over a very common, I would say, complaint, that I get regarding that, or maybe just sometimes maybe just not being aware of how that works. So we have someone buy a property, right? Alabama for $250. It's a rental. When I receive rental income, what do I use against that rental income? Well, I use depreciation, right? Residential properties have a life cycle, straight line depreciation, 27 and a half years. Commercial properties, 39 years. So let's say I buy it for $250. Let's say I put $50 into it, before beginning to rent it out. So I put $50,000 of what we call capital improvements, right? That raises my basis from $250 to $300. And then I rent it for let's say 9 or 10 years. So I took about a third of the original value in depreciation. Now, this is very simplified.
Mm-hmm.
Usually a CPA would assign X amount to the structure, right? And then X amount to the land. You can't depreciate land.
Right.
But for sake of this argument, let's say they took 100,000 of depreciation. So there's our fact pattern, right? We paid 250, we put 50 into it, we took 100,000 in depreciation. Our adjusted basis would be 200. And the math is 250 plus 50 minus 100, right? That leaves 200. So if I sell that property for 500, we'll eliminate closing costs for simplicity. What am I looking at from a tax perspective? Well, the IRS, usually they tax you two ways. They tax you on appreciation gain, and then they tax you on depreciation, right? So depreciation is kind of the hidden tax. A lot of people don't factor it in when they sell a property. Using that same example, if I sold a property for 300, I would say, okay, I didn't make any money on it, right? Because I paid 250, I put 50 into it, and I sold it for 300. So those even each other out. But no, because I've taken value against the property over the years. So by the way, you can depreciate a lot of things. It's not just it's not a one-off. You take it and you're good, right? Sometimes the rubber meets the road down the line, or almost always. Mm-hmm. So if I sold that property on the depreciation, I would have federal tax of 25%. So the recapture tax is of a flat 25, and then I would have Alabama state tax, right, of 5%, which is pretty standard. And so that would be 30% on 100K. That's $30,000. The other tax on the appreciation would be long-term cap gain, which for most people is at 15%. And then if you are of a certain income bracket, it can go a little higher to 20%. We can get into that a little bit. That is a more complicated math problem, but basically your ordinary income is your starting point. So, if you go online and you type in, long-term cap gain rate, you'll see a 0% level, you'll see a 15%, and you'll see a 20% level. I've had a few clients look at that 0% and say, oh my gosh, I don't have any tax, right? Because I make $60,000 annually. I'm married. And it says on here, if I have less than $80K, right, I have a 0% cap gain rate. So using my example, right, so that $200,000, none of that's going to be taxed, right, because I'm at $60K. Mm-hmm. Well, no, $60K is your starting point, right? That's your baseline. And so $60K to 80, right, the first $20,000, that would be at zero. And a lot of people take advantage of that, right? Mm-hmm. And we'll cover how you can do a partial 1031. But the remaining 180 would be at 15%, right? You're not going to skirt that. It's kind of similar to how your ordinary income gets taxed, right? And you should never turn down a raise because only that level above the certain amount gets taxed at the higher amount. It's not as if the whole amount is now taxed at. We're dealing with blended rates. So whenever a CPA or tax advisor says, yeah, you're going to pay around 21%, they're doing quick math and factoring in the blended rate of this amount's taxed at 15, this amount 20, this amount 23.8. So where's the 3.8 come in? It's the affordable healthcare surtax. That's on net investment income. It includes the sale of investment real estate. And so that's a 3.8 surtax on any amount above $200,000 for individuals and $250,000 for married couples. And I would kind of put a bow on this and say all of this is looked at in a given year, right? So a lot of people call me sometimes beginning of the year and they say, well, using my example, I have a sale, there's depreciation, there's appreciation, but I don't think I'm going to have much other gain. And I would argue like, well, how do you know, right? You don't know if, you're one of your stocks, or maybe you have crypto that explodes or something. So, while you can look at individual sales and gains in a microcosm, you file the 1031 on your tax returns, which you report the following year, right? And so everything's kind of looked at towards the end of the year. And basically what the 1031 does is it wipes away that gain/tax. So on the appreciation gain, going back to it, the 200,000, I would say if we're just looking at a microcosm for your average viewer, they would probably just be at 15%, but probably for the full amount. So 15% on 200, that 3.8 surtax might kick in on a little bit of it, right? So maybe 50,000 has a surtax applied, and then we apply Alabama state tax. So 21% would be a pretty fair blended rate on that. So that's in 42,000. So we got 42 on the appreciation. We got 30,000 depreciation. So the total tax would be $72,000. Well, that's why people do 1031s. I don't even need to go much further, right? If you have 500 to reinvest versus what is that, 428, you should be able to grow your portfolio faster and get a higher return. Let's add in the debt once again, right? Let's say someone did buy a property for 250 with a $200,000 loan. Well, who gets paid first when you go to close? The bank, right? So our net proceeds, if I sell for 500, is going to be 300,000. Does the fact that we have a loan of 200 change my previous scenario? Like I said earlier, no, it doesn't, right? There's no difference in the eyes of the IRS. So I'm going to still have a $72,000 tax on that sale, but now instead of having 500,000 cash, right, I only get 300 because I had that loan. And so now my net proceeds, if I didn't do a 1031, would be 228. And so cash is king. We all know that. And so 1031s really become even more beneficial when you do have a loan on the property you're selling. You know, a lot of people will tell me, and it's because of the rules, like, well, I don't want to do a 1031 because I don't want to go back into debt, right? I hear that all the time. You know, the vast majority of people do have loans on their properties. You know, we all love Dave Ramsey, but, you know, most people like to leverage their cash. And so with that in mind, it is true, you know, if you want to defer all your tax in a 1031, the IRS wants you to put it all back in. So going to the second part of your reading of our lovely book, you know, the requirements to fully defer is basically buy equal or greater to the sale price, less closing costs, but we'll simplify it. You know, the IRS will allow you to reduce commission, you know, normal costs associated with the sale and purchase. So that kind of helps bridge the gap. But you sell for 500, simplistically, you need to buy for 500 to fully defer. So a lot of people will have two objections to that. They'll say, one, that's unfair. Why can't I just reinvest the profit? You know, why am I having to put it all back in? I've already paid tax on my initial investment. I'm being taxed on already tax dollars. That's not true, right? It's one of the few occasions so your gain or profit when you do a 1031 is vastly important because it determines whether it's worth doing, right? If I have a sale for 500 and my adjusted cost basis is 475, so I have a gain of 25,000, do I need to do a 1031? Probably not. Now, we both know the tax on that would be about 5,000. What's our fee? Our fee is about 1,000 to 1,500. So there still is a margin there, but I probably wouldn't recommend a 1031 for that amount of gain. But if my sale price is 500 and my adjusted basis is 200, right, and I have a gain of 300,000, and I don't want to pay that 72,000 of tax, well, the IRS is saying, look, we'll let you buy anywhere in the U.S., okay? So you can buy anywhere in the U.S. with a 1031. We'll let you buy any type of property, which we can cover in more detail in a little bit, but any type of property can qualify in a 1031. You just have to have the same investment or business use intent. You can buy multiple in a 1031. So many people will sell one, buy multiple, or sell multiple, buy one, or kind of endless combinations and defer all the tax. Yeah. But the IRS is saying because of these really 4 core benefits we're giving you, right? We want you to not just reinvest the profit, we want you to put it all back in. And so that is why you would need to buy at 500. So that's the first requirement. The second requirement is reinvest all the proceeds. So in a 1031, if I have a sale for 500 with no debt, so I net 500,000, I cannot just buy another property for 500 at 20% down and then pocket the rest. Sure. Whatever cash is produced from the sale, the net proceeds, needs to go back into more properties. And that's important for people that are doing 1031s. They might have to put more down on a property than they initially wanted to, potentially. Now, typically, there are ways to pull money out with a refi after the 1031 is completed. But any cash not reinvested is going to be taxable. So it's not just buying above the sale. It's also reinvesting all the cash. In my opinion, those are really the only 2 rules. I know our booklet says there's other rules about replacing debt. But if we think about it, if we buy for greater than what we sold and we reinvest all the cash from the sale, we're gonna satisfy that last requirement that you mention every time, right? That last requirement said replace debt, but debt can be replaced with more debt or outside cash, And so if I have a loan, going back to, I keep changing my hypothetical from the debt to non-debt. If I have a loan of 200, my net is 300,000. Okay. If I buy something for 500 and I reinvest the 300,000, well, if I came to you, right, you were selling me a property, you were selling it to me for 500,000, and I said, here's 300,000, let's close this deal. You would say, nope, you're a little short, right? You're missing 200,000. So, most people just get another loan. That's the easiest way to do it. But you can come up with outside cash. You could pull money from a different property. Seller financing is becoming very popular from a buying perspective, right? You negotiate with the seller, and they basically act as the bank. You could pull money from your investment portfolio, borrow against it. I've had people do hard money loans. Probably wouldn't be my avenue, but we have people do whatever you want. But as long as you buy for in my scenario 500 and reinvest the 3, you'll take care of the debt. And basically the argument for that exchange is you're not giving money to the IRS for them to use. You're using your own money to grow your portfolio and get a higher return. It's not anything special. The 1031 is really just a tool for investment 101. What is investment 101? Whether we sell real estate, whether we sell stocks, crypto, baseball cards, right? Stamps, it's sell high, buy low, right? You want to sell at peak value, or maybe you're in a certain area where you have difficult landlord rights, you're getting punished for being a landlord. You could probably read between the lines of where we get some of our clients coming from recently, right? Maybe you have a very high state tax, and you feel like you're getting punished for that, so you want to get out of that state. Again, you could probably guess which state I'm referencing there. There's a variety of reasons why people do 1031s, but ultimately what they're trying to do is for X, Y, and Z, they're not satisfied with their current property. They think there's better opportunities elsewhere. The 1031 is just allowing them to fully capitalize on that opportunity. And I think that's the best way to look at it. It's not a cash out strategy, right? It's not a, escape debt strategy. It's a return on investment strategy.
We hope you're enjoying this conversation with Luke Hayes. Please tune in next week for part 2. This podcast is proudly sponsored by 256 Realty, investors helping investors. Big thanks to our production team at AVO Multimedia Services for producing, editing, and providing the music that brings this podcast to life. If you enjoyed this episode, be sure to subscribe or follow the podcast on YouTube, Spotify, Apple Podcasts, or whatever you please. We'd love it if you'd leave a comment, review, and rating. It helps us grow and continue to bring you valuable content. And of course, investors love to share good knowledge. If you enjoyed this episode, please share it with a friend who's ready to level up their investment game. To catch more episodes and video content, visit our YouTube channel at 256investor. Want to get in touch? Visit our website at 256realty.com. We'd love to hear from you. Until next time, keep investing wisely, and we'll catch you in the next episode.